what you're trying to really do is to figure out, what is this company worth it? You try to put a price tag, and then you go and check in the market, and then you go and check how the market is pricing it. Bear in mind that your valuation is an approximation. As I always say, I'd rather be roughly right than precisely wrong. Yeah. You see in a lot of report a precise target value of what it should be worth it up to 2 decimal point, which I find it ridiculous, right? It's an art.
Yeah.
And therefore you need to apply what Buffett keeps saying through also is a sort of margin of safety. It's like you have a bridge that can hold a certain amount of kilos or tons, and you don't want to let them track pass it for the exact amount of tons it says, maybe a little bit less, because you want a little cushion of safety. Same works for valuation. You need a certain cushion around that.
So what creates lasting value for shareholders?
It's a return on your asset or on invested capital that is higher than the average cost of your capital. It's very simple.
Michele, thank you for joining me today's episode.
Thanks for having me.
Tell us a bit about yourself.
I'm a byproduct of finance, to be honest. I started when I was around 22, 23 in investment banking. I joined JP Morgan in London in 2002, 2003, so pre-financial crisis. All good years. You're very young, you joined the trading floor in equity, and you just see the exact Gordon geckos as you saw in films and movies, right? So yeah, you started by practically thinking you are the star of the show as soon as you arrive somehow, because you're very young and you realize you just bring coffees and learn from the others, right? That's exactly what happened. But it was a good, let's say, coffee experience, because you capture the knowledge, the way they do business, and all of a sudden you are projected from your little world into a world where you can barely count the zeros. So, and I remember one of my mentor back then, he says, Michele, always remember, stop thinking in thousands, think in millions. Mm-hmm. And that was a good start, especially for somebody like me. I come from a normal middle class family, and sometimes holidays, maybe we wait next year because this, so all of a sudden you are projected to that. And I found myself in finance. I liked the world of investing since I remember, really. And it's just more of an art. But anyway, I stayed in JP Morgan for around 7 years. I passed the financial crisis. And then I went to London School of Economics for a Master of Science. I decided that especially after the financial crisis, the environment wasn't as exciting as it used to be, put it that way. And plus, I had my stint of 6-7 years, enough to start thinking what next steps are. So I thought to go back to study. And then I joined Bank of England, which I would have never expected in the first place to join a massive government or semi-government institution like a central bank. But it was the best thing I've done, because somehow back then, especially in the UK, the entire concept for the central bank was changing, where the former FSA was being dismantled, and part of the FSA was joining Bank of England as Prudential Regulation Authority. So I joined, and it was practically a brand new, let's call it business back then. And so very exciting. And I was supervising, eventually, I was the head of investment analysis for the bank. So I was practically in charge for the supervision of around 800 billion of pounds, so almost $1 trillion in assets for insurance pension funds. And obviously you supervise them, you don't make investment decision, but what you do, you shadow some of those investment decisions. Therefore, you need to have the same toolkit to make or judge certain decisions that CIO, chief investment officers of certain companies do. And that projected me to a very, very big scale of all of a sudden becoming the so-called supervisors of these big firms, and therefore more learning, but also a lot of experience from them. I did my MBA at London Business School, Columbia University. I had to do it because, the usual value investing classes and stuff. I grew up with that thinking. I grew up looking at Berkshire Hathaways, and so it was a part of my, let's say, a to-do list, which it was a great thing to do. And then I became co-deputy chief investment officer of a very large Swiss asset management, wealth management. We were in charge of around $12 billion. And that's where, from the bank, but especially there is when I shifted from being a full proper equity guy into a more multi-asset guy, because all of a sudden you need to build portfolio, you need to analyze assets that are not just equity. Clients or investors want diversification in different asset classes, et cetera, et cetera. And so all of a sudden you use the same toolkit of thinking, but it's like, I like to use the same analogy. It's like you're a tennis player, you're very good in grass. So you know how to play maybe in clay or you play at fleshy meadows, but the reality is there are people better than you there, but in the toolkit is pretty much the same. So if you manage to adjust maybe the serve or the volley, depending on the court, then you can still play at a good level. And so that's what you do. You just use the same framework of thinking in investment, and then you apply and looking at different nuances. This until November, when I joined Multiply Group. It's been a big change, an amazing change. But I left London after 22 years. I was practically London, New York, and moved into the beautiful city of Abu Dhabi. It was an important decision as well, because you come with your family, just had a kid. And this was also the right time family-wise, because kid is still 2.5. And, it's easier to make a proper move for your family when they're still so young. Later on, school starts and friends. And so it was the right place at the right time and the right decision.
Oh, we're happy to have you with us, Michele.
Pleasure.
You said something about framework and investments. So this is something that you learned, different frameworks, so on and so forth. You've done it all. What is investments?
I have a short answer and a long answer. The short answer is an art. The long answer is the ability to see an opportunity by also evaluating if there is any risk, because risk is everywhere. And investment is in the eye of the beholder. I give you an example, right? People think of investment, they can think immediately. If you're a real estate guy, you think about buying houses or whatever. If you're an art dealer, it's about a piece of art. And if you are a market guy, it's maybe a stock or a bond. So in reality, the word investment is overarching. It covers a lot of things. So the more you understand, the better. Sometimes, let's say, I say it without any, issue. I don't really like Picasso. So if you're asking me to value something I don't really like, my economical mind goes only on supply demand. How many there are, what is the demand, what is the supply, and then I can give you a valuation, right? Is it worth it or not? But in reality, if you ask me, I prefer a Van Gogh rather than a Picasso. So maybe I will assign as a bias more value to that. Is it a good investment or not? Maybe a Picasso is a better investment. So in reality, for many people, investment is blurred into also what they like, what they know, what they're fixated with. The pragmatic in me says an investment is something that it doesn't necessarily need to have a cash return. It's also potentially a personal value or a value that can grow. But a simple answer could be you buy something at X, it grows in value and in price, ideally, and value might stay the same. Price goes up, it's more appreciated, and you make a few bucks out of it. So that's how a market also works. But the difference is there is a huge difference between price and value, and people often conflate the two.
We'll get to that. But with inflation, and it doesn't seem to be going away, especially with the current financial regulations that are taking place all over the world.
Right.
If you have a bit of cash on the side, it's going to start devaluing.
True.
So better off investing it somewhere, just at least to maintain.
Correct.
Or to grow the value of whatever money you have.
Correct.
So let's talk about public equity.
Right. So when you buy a stock, no matter what market or anything, you need to start framing yourself. First of all, let me step back. There are different things into investing, trading, and speculating. Mm-hmm. Speculating could be on both. But let's say between investing and trading, the concept of trading is generally on a time frame. Trading, you find opportunity maybe in pricing, and the time frame is generally, not always, but generally short. Long-term investors buy a company, not just the stock.
Sorry, but when you say short, is it like a day? Is it
could be
2
intraday?
days?
Paradoxically, some algo trading do seconds, milliseconds, which obviously you need infrastructure for doing that. And so the choice of your security into that in that case is not necessarily whether it's going to really increase in value or not. Often not. It's about whether they have certain characteristics to allow you those kind of things like liquidity, is that they're well-traded stocks, there are volumes, and so on and so forth. You cannot do certain things with stocks that are extremely unknown in a very non-liquid market. So a long-term investors...
Sorry.
Yes, please.
To cut you again.
Yes.
Can we explain what liquidity is?
So a liquidity is, let's say you want to buy a stock. Let's stick with stock, but it's applicable for a lot of other asset classes. You buy a stock or you sell a stock. You can do it in a click, almost whatever kind of volume you like, and you still find a buyer or a seller on the other side, or the market maker, which is the market, has already put aside a certain amount because it's really well traded. Therefore, you can get in and out from that position fairly quickly because he liquidates for you. Let's say you sell it, he can liquidate for you very fast. This is a very good characteristic because in case you need cash, all of a sudden you can sell whatever you have. And you know pretty much on the other end, on the other side of the table, you have somebody buying it. Illiquidity is like real estate. I wake up in the morning, I want to sell my house. It's not like clicking sell on a very liquid stock and selling it straight away. It might take a process of months. So, and this is also, which maybe we can touch it later, a big difference between what we call traditional asset classes and alternative asset classes. In the alternative assets, you have real estate, private equity, private credit. Those are by definition more illiquid than traditional asset classes like stock and bonds. Within stock and bonds, you also have various grades of liquidity. You have the Apple stocks, which is super liquid, or you have a teeny tiny small market capitalization stock in an unknown market, which clearly is less liquid. One way that investors can sense the level of liquidity of a stock is the spread between bid and ask price. The smaller the spread, the more liquid it is. The bid and ask price is what they say the so-called market maker, the middleman, applies because obviously they have to make money on that by allowing you that liquidity. A stock like Apple have a very teeny tiny bid and ask spread because it's really traded. A very unknown small market cap stock have a wider bid and ask spread because obviously it's less liquid than the middleman that needs to try to find it and accommodate your request.
So in a nutshell, if I want to buy 1 million shares of Apple, I can do that in a click of a button. Almost, if I want to sell it, I can do that in a click of a button.
Correct.
For a less known company, if I want to buy 1 million shares, is going to take maybe half an hour or maybe even a day or two.
Correct.
And if I want to sell them, it might take a week.
Correct.
So
correct. And this is something you need to take into consideration.
This is what liquidity is.
Correct.
Okay.
I try to say it in very layman terms, right? So it's how easily you can liquidate or find or buy, an asset.
So going back to what you were explaining, the difference between investing, speculating, and trading.
Speculating is purely trying to speculate on a price on both directions. You can go up or you can go down, right? You can speculate that something will go down and therefore you take certain measures to take advantage of that potential going down, and you do the same on going up on the price. And that is applicable, I would say, in both the trading and investing.
Right.
Investing in terms of long-term or semi-long-term investors, the mental framework changes because what you need to think is, I am buying a company. Even if it's a one share, you all of a sudden become the owner of a company, a co-owner, together with many others. And so the mentality has to shift in order to be successful because you really are buying a firm. You are buying the company. You are buying that business. And all of a sudden, yes, you care about a potential appreciation of the price, but you need to care all of a sudden about the fundamental of the business. Is actually the business a good business? And there are good businesses out there and there are bad businesses out there. Some are intrinsically good businesses because of what they do. Some are good businesses because the management is better than other management. And so when you're a long-term investor, all of a sudden you need to take all of these variables into consideration and not think about what the company does tomorrow, but what the company will do in I would say, few years' time. Yeah, that's the right framework of the problem.
This is investing.
This is in investing, correct. And this is the way I perceive investing. I don't perceive investing in any other form. Then, if all of a sudden certain things happen in the future that will make the price spike, but hopefully for you investor, way faster than what you expected based on your analysis, then clearly your time frame shortens because you say, well, I was less optimistic than actually what the surprise is. So all of a sudden your time frame might actually change. Mm-hmm. But in reality, you are buying a company. Okay. And therefore you need to adjust your mentality by thinking, this is a company I'm buying. I want to know what they do. I need to understand what they do.
Very clear. Very clear. When it comes to investing, what are the best asset classes to invest in?
Oof. Now,
there are many asset classes.
Correct. Now, I'm very biased on this. I think equity remains...
Let's focus on your area of expertise, which is public equity.
Yes. Yeah, I cover a lot of asset classes. Yeah. But I would say public equity have shown in the long run a very, 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 very good returns. Like we are talking about, if you had invested at the very beginning of the stock market in the United States, excluding the COVID period up to 2020, before COVID, you would have made a 7.8% annualized return every year.
You're beating inflation and more.
Correct.
Which is fantastic.
Correct.
Yeah.
So it's like every year, annualized. So there are years. The problem is what we call volatility. The problem is, can you stomach a price that might go down 20%, 30%? And this is about behavioral that if you want, we can touch later.
Sure.
Some other assets, don't have that volatility. If I buy a house, right, I know I bought it for 100. It's not that tomorrow might collapse at 70 or 60. A stock could. And so the mental framework you need to have needs to switch depending on the asset classes. However, I believe that if you are trained to understand what risk is and what volatility really means, then you can manage all the other asset classes easily. And equity is a great playground.
Okay. So
I'm obviously biased on that.
Of course. But let's talk about then risk and volatility, Michele.
Yeah. So there are two ways that you can think of risk.
Okay.
Right? If you look at, I think Chinese say the word for risk, the symbol for risk means risk and opportunity at the same time. Right? And I think it's a perfect...
You lived in China for a while, didn't you?
I studied in Beijing for a while. Yeah. And I think it's a perfect combo for really understanding what that is. So you have, the way I see it, you have two schools of thoughts on risk. One school, which is based on modern portfolio theory, etc., is volatility. The more a stock is volatile, the swings,
goes up, goes down,
massive swings and often, etc., the more risky it is. The riskier it is. The less it does, the more, let's say, stable is the price, the less risky it is. And so you have to assign a sort of expected return based on the risk you take, right? Let's say if I give you an example. I give you something, let's stick with volatility for now. I give you something that has a risk of, let's measure it, 10, and it returns 100. Then I give you something that has a risk of 20, and it returns 100. Which one would you pick? Clearly the one with less risk for the same return. So in reality, if you go on something that has a higher perceived risk, you expect a higher premium for taking on board that risk, right? If risk is volatility, then you can figure out what volatility is and says, okay, for this type of volatility, I expect this risk, this return. In reality, the way I see it, and the way many other investors see it, risk is not just volatility, or it's actually not volatility, but is a permanent loss of capital. which is what my grandma would ask. If I says, Grandma, I invest your pension, the first thing my grandma asks is, what is your standard deviation volatility? No, it wouldn't be that. It says, am I going to lose my money? And that's really the perception of risk for many. And that is, in my opinion, the perception of risk that many investors should have.
A lot of people do lose their money.
Correct. Unfortunately.
A lot, especially those that are regular folk. They're not traders, so on and so forth. They think that if I invest, they watch a movie, they heard about somebody's friend, they put in 10 grand, now it's $1 million.
Right.
They think it's easy.
Right.
But it's not.
Because they see easy money.
But it's not.
Oh. And you know what? The fact that they lose, it means there is somebody else on the other side of the table that makes it.
That makes it.
Right. And that individual has absolutely no intention to say, oh, you shouldn't do this, you shouldn't do that, right? It's the market. And it's the beauty of the market somehow, right? If you think I'm often wrong, I like to be more often right than wrong. And those times I'm often wrong than right, I want to weight my being right being bigger than the more times I'm wrong. That's the game, right? It's a numbers game eventually. You're not right all the time. You might misjudge. And what I think a lot of the common folks make a mistake is, first of all, they don't really understand what they're putting their money into. They think they do. Oh, they buy a company because, I don't know, they make shoes. Oh, I love those shoes, which is also a good technique. But the reality is the fact that you love that product doesn't necessarily mean that that company that produces that product is worth the money you're paying. A lot of these people miss the price they pay. Right? That's the key. They pay too much sometimes. Okay. They pay too much for what is really worth it. And we go back to what I was saying before between value and price.
Let's delve into that.
Right. So in everything you do, you need to detach the price you pay and the value you get. Mm-hmm. The price is really what you pay. Mm. The value is what is really worth it. Mm-hmm. And it's very difficult, but sometimes it's very easy. And we do this exercise every day. Mm-hmm. If you go to a supermarket, right? And it's exactly the same. It's the difference. It's called supermarket, while the financial market is another market. But the dynamics are exactly the same. You see a toothpaste. Right. And all of a sudden, that toothpaste is a very good brand. Mm-hmm. And all of a sudden, it's sold for, let's say, 50 cents of a dollar. You say, wow, that's a great price. And you buy it.
So you mean at a discount?
At discount. You don't know. Well, forget whether it's a discount or not.
No, but let's say you 50 cents on the dollar. Some people won't understand. So that.
50 cents. Let's say it's less than $1. Let's say it's less than $1. Mm. You probably buy straight away because you think, okay, that's an amazing brand, amazing toothpaste at a very, very cheap price. If the day after you enter the supermarket again and that same identical toothpaste is sold for, let's say, $200, you just say, oh, that's crazy. Why? Because in your head, very likely you had that a fair price for that toothpaste is around what, $3.50, $4. So if it's sold at $1, you buy it. If it's sold at $100, you don't buy it. Why? Because you have a mental anchoring that a value for a toothpaste should be around $3.50, $4, whatever that is, right? But the market works exactly the same. If I come to you and I say, Apple stock now trades $198, right? The difference is you don't have the anchoring point of what is really worth it, and you need to calculate it.
How is it calculated?
We can discuss techniques, but that's the art as well. But in reality, sometimes market misprice it. Sometimes the financial markets or the stock market can give you that toothpaste at 50 cents of a dollar, and sometimes can give you that same toothpaste at $100. So your ability is, in either sense, to understand really and feel comfortable of what the company does, what the company do, what is really worth it, and whether at that point the market is pricing it correctly. My opinion might be different than yours of what is pricing correctly or not, and that's why discrepancies are coming, right? You might value certain things on that company because it's not a toothpaste that will lead you to thinking that it's worth it X, while I think maybe it's worth it Y. Mm-hmm. And that's why sometimes there are people selling and people buying that have an understanding of the company, because for some it's worth it, for some it's not. So the difference between price and value is key, but it's easier said than done. And financial people have techniques to calculate it. Classic discount cash flow model without going into
the
technical details or multiples or residual values. So what you're trying to really do is to figure out, what is this company worth it? You try to put a price tag, and then you go and check in the market, and then you go and check how the market is pricing it, right? Bear in mind that your valuation is an approximation. As I always say, I'd rather be roughly right than precisely wrong. You see in a lot of report a precise target value of what it should be worth it up to 2 decimal point, which I find it ridiculous, right? It's an art.
Yeah.
But, and therefore you need to apply what Buffett keeps saying through also is a sort of margin of safety. You know, it's like you have a bridge that can hold a certain amount of kilos or tons. Yeah. And you don't want to let then track pass for the exact amount of tons it says, maybe a little bit less, because, you know, you want a little cushion of safety. Same works for valuation. You need a certain of cushion around that. Market's craziness will allow you a price all of a sudden that is so low or so high that it's quite easy to see that is either extremely undervalued or overvalued, because market generally price it well, but there are moments in which greed and fear misprice it.
This brings me to a question, which is, what creates lasting value for shareholders?
Okay, this is a completely different topic. It's the same topic, but it's a very important topic, because I think this is the key. From a purely financial perspective in a corporate finance world, there are 3 pillars for creating value to what our shareholders, i.e. owners. Even if you buy one share, you're a shareholder of that company. And these 3 pillars are, and I think it's kind of common sense, a purely investment pillar. And it says, what do you mean? So let's imagine this. I try to explain difficult concept in layman English here.
You're really good at that, so.
Thank you. So imagine, I try.
No pressure.
So imagine this. So if you take this, if you walk into a company, let's say, and you have these magic goggles to see all the company has and all the debt the company has, right? Which is called balance sheet. Somehow the balance sheet, it tells you a picture of, generally it's 31st of December, depending on the regulation of the country, of what are the stuff the company has and I owned, and the stuff that the company owes to others, right? Own to others. So on the left-hand side, let's say you have the assets. Assets could be the cash you have in your, in your cash thing. You don't think about the big companies. This is also worth it for a little cafe downstairs, right?
Let's talk about the cafe.
It's exactly the same principle.
Let's just simplify.
Correct. So imagine the cafe downstairs, right? So imagine you and I, we decided to open a shop, a coffee shop. There are so many, so we better have really serve good coffee, I suppose. But
you're Italian, so it will happen.
Correct. So it better be good. Let's say we decide to do that. Let's say we need to finance ourselves. So we have 2 options to put the money in order to buy the building or rent the building, buy the coffee beans, buy the machine, nice napkins, and
table, chairs, decoration.
Assets. Those are assets, okay? In order to pay for that, we have only 2 sources. My pocket and your pocket. Maybe some savings. And some other people's money, right?
Or we take a loan.
Exactly, some other people's money, or a bank loan. Other people, other entities' money. So if you look on the right-hand side of the balance sheet, therefore you have an influx of money coming either from equity shareholders, my pocket, your pocket, and a portion from a bank loan. Right? This money coming in has a cost. For that is very easy interest. For our pockets, it's slightly more difficult to figure out what is the cost for us, which is not just the money we put, but technically you need to figure out a percentage cost of what that money for us cost, right? Because you say, well, that's my money, costs nothing. Oh, actually it does, because you could potentially invest that money elsewhere and get an income. So for us, in our own pocket, it's a cost opportunity, put it that way.
The opportunity cost,
right? Which you need to put a valuation on it. So let's say 5%, 6%. We can discuss all how we can calculate this.
It's getting a bit complex. Let's just leave it.
Correct. But let's say our money costs 5%, 6%.
Right.
Borrowed money from the bank, I don't know, 7%, let's say. So we need to put it together. Let's say the combined cost of our debt from our pocket, shareholders, and the bank is, let's say, 10%. So we know that is a 10% cost. So now we take this money, 10% cost, and we need to buy the assets. What is the minimum return you expect this asset to give us? Well, at least 10%. Yeah. At least 10%. Because otherwise we have a return on the assets which is lower than the cost of the capital that we need to raise from our pocket and somebody else to invest in those assets, right? It's a very simple concept. I can explain it in an even better way by thinking about printers. So imagine we can have the chance to buy a printer that actually prints real money. Okay? Imagine that. Real money.
From where?
I don't know. I can think about it.
Tell me. That's why it doesn't.
I can think about it. But imagine it prints real money, right? In the moment in which we buy this printer that prints real money, we still need to borrow from somebody else to buy the printer in our own pocket, right? And let's say the printer costs $100 and the cost for us is $10 a year. How much money do you want this printer to print at least? At least I want it to print at least $10, ideally more. So that the money that I paid, I can repay at least the cost of that in terms of real cash, right? So a lot of people conflate, and let me add this, growth with value creation.
See, this is what you need to explain.
Right. Growth is nothing else than an accelerator or a destructor of value. It's not a value per se. You say, what do you mean? In the example of the printer, imagine that we borrow at 10% to buy the printer. And the printer, rather than printing at least $10, print $8. And then we say, oh, we should expand and buy more of these printers. So you're growing because you're buying more printers. But all these printers are printing $8 while each printer costs us $10.
So we're losing money.
We are losing money. We are growing, but we are losing money. We are destroying money. So growth per se is nothing else than an accelerator of value destruction, like in this example.
Not all the time. In this example.
In this example.
Yeah.
Or value creation.
Yes.
If in reverse, our printer prints $12 a year and it costs us $10, then that's value creation.
Exactly.
Then the more I grow, the more printer I buy, the more I create value. So growth per se is not an indication
not necessarily
of value creation. This is what is inflated all the time, conflated in the news, right? Yes, oh, the company is growing at X. All right, but is he a printer that prints 8 or is a printer that prints 12?
Yeah.
In my example.
At a cost of 10.
Correct, at a cost of 10.
Exactly.
Right.
So what creates lasting value for shareholders?
It's a return on your asset or an invested capital that is higher than the average cost of your capital. It's very simple. So you borrow at X, is your hurdle rate. You need to find project or investment that through your asset creates a higher return than that.
And to be able to read that on the balance sheet, if you go on Yahoo Finance or Bloomberg or whatever.
Right.
You need to be financially literate.
Correct. However, and this is a very good thing, many websites now, we didn't have them before, but many are calculating it already for you.
I didn't know that. Okay.
Yes, you find tons of free websites now.
I'm still old school. Okay. Like what?
Oh, I don't want to marketing them.
No, it's not marketing. It's just...
Well, you need to look at a website like you have Roik.ai, I think is, or you got Guru Focus, or you have... Data Roma, I think there are quite a lot that are free.
What do they do exactly?
They do this kind of, they do a lot of fundamentals analysis, so understanding really the quality of those assets, etc., blah, 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 blah. But they can give you a quick snapshot of exactly what I explained to you.
Okay.
Because financially, we calculate this through return on invested capital or return on capital employed versus what we call it WACC, which is the weighted average cost of capital, which in our example of the printer is the 10%. A mix between what you borrow and our
the WACC is the weighted average cost of capital.
So what
which is the 10%.
Correct.
Exactly.
Correct. And so you want a ROIC or a return on capital employed, i.e. the return that happens from your asset.
Let's use less acronyms and just say The full.
You want want the assets to have a return based on your infrastructure, etc., higher than your weighted average cost of capital.
It makes perfect sense.
All right. So this is one of the main pillars. Second pillar is, let's stay on the weighted average cost of capital, the debt and equity, right?
Yes. Because it's very simple to understand.
A lot of people say that is cheap, right?
Is it?
Or cheaper than cost of equity. It's a classic thing we say. And the reason why they say it is...
Okay, let's just explain the difference here between debt and the cost of equity.
Okay. So as I said it before, in our example for the printer, we have a bunch of money in our pockets. That's cost of equity is for us, shareholders. Yeah. And then whatever is left, let's say in our simple example, we borrow it from somebody else. That is quite easy to calculate.
That is the debt.
That's the debt.
That's the debt. So the money that we borrowed from the bank or from
5%
our family or whoever.
Bravo.
Yeah. Okay.
Right?
Okay.
And then for some reason, without going into details, we calculated that our cost of equity, ours with our own money. It's another 5%, let's say.
Yeah.
If you want, we can discuss how we put a 5% on our cost of money. If you want, I can go quickly here, but you have to look at it as a cost opportunity, right?
Yeah, the opportunity cost.
Call it that way. Let's leave it for now.
If I have $100, okay, I can either use it to start up a cafe or I can go buy
a 5% bond.
A bond.
Correct. At 5%, that's my cost.
Super safe. That's it.
It's not really like that, but for now, let's leave it like that. This is something that a lot of people within the field call it, in order to calculate their capital asset pricing model. So it's a kind of a formula, which is basically a sort of cost opportunity.
Please go ahead.
Right. You want me to go in detail?
No.
Okay, exactly.
Let's go back to you.
Okay, so we calculated that our cost of equity, let's say, is 5%, because I could have invested at 5% elsewhere. And then you have the debt.
Yeah.
Which is quite straightforward because, it's what the interest rate you have to pay on that. The nature of the two is slightly different, of course. One is your pocket, is money from your own. And the other one is borrowed money. Borrow money has a characteristic that the interest you pay on that borrowed money is tax exempt. So you can deduct it before paying taxes, right? So technically you pay less taxes, right? Let's say at the end of the day, I make 100. Let's say I have to pay 20% corporate tax, it's 20. So my net income becomes 80. But if I have some interest to repay, that 100 technically goes a little bit lower than 100. Let's say I pay 5 of interest, so it's 95. Then I pay 20% on 95, which is clearly less than 20. Therefore, the more debt I take, pari passu, the cost of equity at 5%, technically the better it is because I pay less taxes here, right? And so people say, okay, debt is cheaper. Cheaper because the tax effect on the interest I pay makes it technically cheaper. I pay a little bit less at the bottom line at the end of the year. But where is the catch? There is a catch, because then why not all companies or not all of us are 100% debt? Why do I have to even put my money into that, right? It's because the more debt you stack up, the riskier you become. And people perceive you as riskier, therefore they expect more return. And therefore your cost of equity, that 5%, increases. Why would I have to price you at 5% like, let's say, a simple asset that gives me 5% less riskier? In the moment in which you stack up so much debt, I don't want 5%. I want more than 5% to compensate, as a shareholders, the riskier you're taking compared to a non-risky asset.
Yeah.
It's a logical approach, right? So
it is.
So there is a point where you have benefits in increasing debt, but that benefit all of a sudden start going down because the more riskier you become due to the debt you're stacking up, your cost of equity goes up, and therefore your total goes up again. And so the ability of many CFOs, CIOs is to figure out the sweet spot between the level of debt and the level of equity to maximize or better minimize the weighted average cost of capital. Because you stack up debt, yes, it's true. Your cost goes down because debt is cheaper. There is a point of inflection, however, when then the cost of equity, because you becoming riskier and riskier, keeps going up. And then he unfortunately eats out the benefit of the debt. And so the ability is to also find companies that manage the right balance between debt and equity to maximize or better minimize that cost. So this is the second pillar. So one pillar is, I said, again, you want your asset to have a return higher than what your cost. Makes kind of perfect sense. You would be surprised how this should be a common thing, and it's not. And I can touch on that. The second is, within that cost of capital, you want to maximize the perfect balance between debt and equity to minimize that cost. What is the third pillar? Is what I call a return to shareholders.
Okay.
If you're a shareholder, if you own a company, let's really speak plain English. Where do you make money as an investor? Because at the end, that's the goal, right? You make money in different ways, potentially. And this make money is a very loose term. From price appreciation, right? I buy at 100 in whatever XYZ months or years is worth 120. From dividend. Stocks can pay dividend, which means every quarter, every 6 months, every year, depending on
the dividend policy of the company.
The dividend policy of the company, correct. They actually pay you actual cash.
Yes.
Right? That portion of the cash is taken by the bottom line of their operation. They distribute some cash. They decide how much cash is distributed, and then so on and so forth. Now, I ask you a question. If, in my example, you have a company with a printer printing $12, $15, $20 real dollars for a cost of 10 and growing, keep growing, and they really know what they do you want them to pay you dividend?
Not today.
Correct. Somehow, the way they manage cash and return to policyholder is very important, because very likely, I want, if the growth is in a very good stage, I want that cash to buy more printer. Don't give it to me, because it's exponential, the growth and the value creation. Correct, right? So dividend policy is key as well.
Yeah.
Price, in theory, price appreciation should just be the end solution of when market realize that the company is value creation. The company is creating value, the market rewards you for it, right? So price is paradoxically the last thing you look at, because all these decisions put together that creates value, if the market is a good weighing machine, eventually, sooner or later, we realize that that is a great company creating value. Therefore, the price of that company should go up to match the intrinsic value of what they are generating. It's a weighing machine.
Absolutely.
Right?
Any good companies that currently are in the stock
market
that you can reference?
There are many.
Yeah.
Allow me.
But just 1 second. This is not financial advice. It's just for pure educational purposes.
So the world has changed. If you look at the top companies of the good companies, you look at the top 10 companies 50 years ago, 60 years ago, none of them is still in the list, right? It's part of, I suppose it's part of
the evolution of
things.
Yeah.
However, this evolution has clearly taken a very specific direction, which is in technology, right? Technology has, I think, taken over some of the traditional businesses, even though I think boring is good, and some of the traditional business will never die. True. Why? Because of human nature, right? You still need to eat. You still need to go to school. Well, you don't need to, but I mean, so there are certain
elements. Concrete, iron, steel, logistics, transportation.
Correct. There are still, but
the boring stuff.
Correct. The boring stuff. And boring is good.
Absolutely.
But everything has a price. That's the thing. Even if boring is good, but if the price is wrong, it's not the right thing. Technology has kind of changed. So in the last 20 years, all of a sudden you have the usual names: the Facebook, the Microsoft, the Apple, the Nvidia, right? So it's very technology based. And why is it very technology based? With the Google, of course. Why is it very technology based? Allow me to say this, because I think it's very, very, very important. And we touch on something that eventually, if you want, we can discuss later. In the example of the printing, right? We buy this printer that prints real money, right? Do you think we are the only one potentially that wants to buy those printers?
Hopefully.
Hopefully. But in reality, I'm afraid it's not the
Otherwise,
case.
you can have inflation.
There are a lot of people, but there are a lot of people that says, oh, wow, they are buying those printers. I want to buy those printers too.
Of course.
So imagine what happens. Everybody wants to buy the same printers that we are buying that prints a lot of money. What happens to the price of those printers? They go up. Therefore, our margin, the $2 for the 10 that we pay, is probably going down, right? And there's a point where it will go down to 10 and makes it not viable for us anymore. That is, unfortunately or fortunately, an open market with competition. Some company managed to fence that competition off better than others. And that is called what is Warren Buffett called the moats, or the competitive advantage. If you have a very strong moat or competitive advantage, for others, in our example, to buy those printers too, is much more difficult than for us as a first mover. So the ability to create a competitive advantage vis-a-vis others allow you to keep buying those printers at that prints $12 and keep buying more. And so you see that first pillar of value creation, they keep creating value. And the price keeps going up because the market realizes how much value they keep creating. Apple, Microsoft. I'll give you a perfect example. Microsoft has a huge moat. Try to change Windows from all the computers around the world with any other operating system. Good luck. Good luck. So do you think Linux didn't try or others? Yeah, of course, but it's nothing compared to also the headache that many companies or a single individual needs to do, because a lot of software now are based on Windows operating systems.
True.
That is a massive moat, right? First time mover, consolidation, for whatever reason we can discuss. Their return on invested capital, that kind of return that those are the printers, they keep buying printers. Nobody can buy printers like them, in my example. Apple is the same. Some are stronger moats, stronger competitive advantage than others, right? Others that are first-time movers and, for example, realize that their competitive advantage is not like the Microsoft example. What do once they have established themselves? They buy off the competition. So some of these companies keep a very large cash balance because as soon as they scout companies that can potentially put them a threat in terms of in their own market, they buy them out at the very beginning. And so, and they consolidate the technology, etc. Google is a perfect example for this. They have been doing this for a long time. They go, they see that is a very good search engine, or code or source code. I buy it. And then you have the young guy that all of a sudden create that amazing source code. All of a sudden he sees on the table $500 million for his company. He buys it. He says, yes, it's yours. I mean, I've never seen this money in my life.
Exactly.
Right? So there are different ways and moat is a perfect example of how you keep in the first pillar, the value. Companies that you ask me that are very good are these companies. But there are other companies that manage to maximize the three pillars, as I said. Not only the first, not only having a very good CFO, CIO that managed to optimize the balance between debt and equity, but also the return to policy shareholders. And I want to stop here 1 second because I think this is very important and a lot of your viewers might actually understand this on a day-to-day. A lot of companies decide to pay dividend, right? The signal you give me when you pay dividend is that you don't know where to invest anymore, or you find no more interesting projects in the pillar one, the printers. There are no more printers we can buy for that. What do I do with this cash? If you don't know where to put this cash, in theory, you should return it to the owners, shareholders. First, you see that that's not happening many times. Many companies with, I would call it, not necessarily good management, rather than returning money to shareholders where there's nothing more to do, they start going into spending spree, buying other companies, or continuing into an exercise that doesn't create value.
Or buying back their shares.
Right. That's the third part of the third pillar, which I haven't touched on purpose yet.
Okay.
Because I said that there are so far price appreciation and dividends for you as a shareholder to extract that value at the very end of the value chain, right? But the third one, as you said, is buyback. Is exactly that. Buyback. What does buyback mean? By the way, for who's listening, a company can invest. Let's say our coffee shop the example before, we decided that, we can still buy some Apple shares. We can do that. I mean, a coffee shop wouldn't, but let's say you can invest in companies.
And Starbucks.
Starbucks can buy Apple shares in their assets. Part of that printers generating that could be even stocks and bonds and some liquid investment, etc. But out of all those investments, they can buy themselves. They can buy their own shares. It's another investment, right? It's a perfect way of saying, I'm Apple or I buy my own shares. However, there are nuances here. Because what you signal the market is that in general, nobody better than you should know whether the market is pricing you well. I should know my company inside out. I work there. I run that company. Therefore, if I buy my own share, I need to think I'm buying my own share because I think the market is mispricing it and is probably cheaper than what I think is really worth it. And nobody better than me knows how much it's worth it. So if I do this in an ideal world, I am signaling everybody else, hey, my stock is undervalued. The market is mispricing. I think it's worth 100. It's now pricing as 72. This is a great investment. It's actually my own company. In reality, it doesn't happen often that way. Only few CEOs, a real capital allocator, buy back their own shares when they really think they are mispriced. One of them, obviously, famously, is Warren Buffett. Many others, and I can also explain why I think that's the case. Many others don't do that because they think their stock is undervalued. Many do because it pushed the price up. By definition, right? You buy a lot of the cash to buy your own shares, the price goes up. And so the devil is in the details there. What every good, intelligent investor should do, they should see, first of all, if the management that decide that buyback has a skin in the game in the company. And you will be surprised how more often than not, the skin is very, very slim. So who's going to gain from that purchase? You need to look at also their retribution policy. Some of this management might actually be paid a bonus based on stock price level. So it's a purely moral hazard. I don't really care in the damages I'm doing from a value creation in the long run, but the more I push the price up, the more I get paid a premium or a bonus because my bonus is linked to a price. Right? That's a recipe for disaster.
Of course.
Right? So the intelligent investor, as we discussed at the very beginning, once you become an owner, you need to also understand who's running the company, what skin in the game they have in the company, what interest they have in the company, what type of policies, management or incentives management can have that can be counterproductive to the value creation principles that you as a shareholders deserve. And that's the key. So in the third part, the buybacks could be a great value creation, but it can also be a great value destruction. Not to even mention a lot of M&A, merger and acquisition, etc., etc. The majority of M&A, because all of a sudden you can't buy printers anymore, you sit on this pile of cash. What you should do, because you are just buying printers, you should return money to shareholders, but they start saying, okay, now we do something else with this cash. More often than not, you destroy that cash, you destroy that value. This happens in M&A, this happens in acquisition. The history is full of bad acquisition or bad projects because a human behavior enters into that conversation, which is big is good. I'm the CEO. All of a sudden, from a company of 300, I'm the CEO of a company of 3,000. I go on this network show. I become a big CEO here and there. And all of a sudden, you lose the real goal of a CEO, which is purely returning value to your shareholders. Nothing else, nothing more. And that's why many merger and acquisition are penalized by the market because market immediately perceive them as, going back to the same first pillar, value destruction.
Some companies do the mergers and acquisitions, for example, for the sole reason of there are no more printers to buy.
Correct.
But we can buy companies that own printers.
True. But they make a massive mistake there.
Why?
You miss at what price?
Again.
They overpay most of the time.
If they're buying at a good price.
Oh, your safety net is the price.
Exactly.
Because even if you do the worst mistake in an investment, but you bought it at a crazy cheap price, you're still safe. The price is your umbrella.
right? If you overpay and it's a mistake, it's a perfect disaster. If you overpay and it's a great investment, you get out of it.
Yeah.
If you underpay and it's a great investment, you are fantastic. If you underpay and it's a bad investment, you're covered. It's a matrix. It's almost a matrix. It's like 4 quadrants. What is the right price? Then again, it goes back to what we discussed before.
Michele, markets are ultimately driven by human behavior.
Yeah.
So what patterns have you seen repeatedly?
Greed and fear constantly, but you don't have to look at market today. You have to, it's enough. You go back to the East India Company back in Isaac Newton time, or, the tulip. I think it was the tulip bubble in Holland. And, history doesn't repeat by rhymes all the time, because human behaviors are the same, are always the same. Nuances, it's shades of grays, right? The key here is I think, and I completely agree with Buffett. One day in one of his Berkshire shareholders meeting, he said, the real success now for those that really understand markets is to how lucky you are to live in your lifetime crisis. Because crises create amazing opportunities, right? It creates amazing opportunities for those that are brave and, I would say, educated enough to understand that the opportunity is right there. And those are generally called contrarians. A contrarian in life and in markets are those that somehow, like in the Chinese word, don't see necessarily the risk, but see the opportunity too. And a lot of people think they do, but in reality, they don't. So it's the one that in a crisis has the tool and the cool mind to really see an opportunity in certain things. When the market picks up and goes up, everybody's a genius, right? But in reality, you have to see the good decision when the market is really going down for companies that are solid. A contrarian is the one that is less affected, I would like to say, by greed and fear of markets. It's the power of the herd, right? It's the lemmings world. Then we can discuss the microstructure of market, whether are the common folks that has moved that, or the big banks. We can discuss that. But you need to watch out for those sentiments and that behavior. There is a lot of behavioral involved. And you need to have a very, very, very strong foundation because it's very difficult, almost impossible to time the market, right? You might think you reach a bottom and you say, now the market pick up, and the market might not pick up. The market is always right, no matter what, even if you think it's completely hysterical. Eventually, that's what pricing stuff. And so it might stay low or it might go down for another 20%. Do you have big shoulders big enough to sustain a 20% without panicking and selling it? That's the key. I don't have an answer for others. I have an answer for me. And it's about conviction. If you've done your work, if you understand the company deep down, if you really understand that that's the right price, then paradoxically, even a 20% drawdown becomes a better opportunity than when you bought it in the first place. If the narrative hasn't changed, if the company hasn't changed, but it's just the market still being fearing for a little while longer, maybe you can average down if you have the ability. So, which leads me to also having the ability of maintaining a certain amount of cash in order to adjust this position going forward. That's key, because if I'm fully invested and the stock goes down 20%, the only thing I can do is waiting.
Yeah.
If I maintain a certain level of a room for maneuver, as I call it, to adjust some of this position and wait for finally the market to pick up, it's obviously better.
When is the right time to sell?
That's something I love.
This is a mistake that a lot of my friends do.
I made it so many times.
I've made it so many times as well, and I've learned from my mistakes. I always have a sell target price, be it up or down.
Yeah.
Because wishful thinking doesn't work in the markets, right? Correct. So if I bought it at 100, it went down to 90. I'm like, oh, it's gonna go up. It's gonna go up, and that's wishful thinking, man. You should always have a floor and a ceiling.
Yeah.
So if you can please explain, when is the ideal time for people to exit?
It's funny you say that, because I always say this. I mean, I went to really good business schools and stuff. At the end, nothing like practice really teaches you things, especially in
100%.
markets, right? You get a good framework. As I said, you got a good tennis players. Now all of a sudden you think you know how to serve and volley and this and that. And then all of a sudden you find a central call in Wimbledon and you get destroyed 6-0, 6-0, 6-0. And you say, but how is that possible? Like I was taught everything. And because practice is different, because practice involves behavior rules, as we said. And schools don't teach you that. And they never teach you really when to sell. They always tell you what to buy, when, how to find the opportunity. But they never really tell you, okay, get out of it.
Yep.
Right? Now, the best situation would be, in my opinion, you hold it forever. Printer exercise we did?
Yeah.
Okay, maybe they don't buy many more 5 printers with that margin, but now they buy 3. Still great. What should drive your decision? It's, in my opinion, and this is purely mine, twofolded. One could be the price you said, and the other one would be other opportunities out there to make your money work better in other companies rather than the one you have. So, to explain. You remember the cost opportunity we said that the 5% either we put in our coffee or we put it
equity,
there.
yeah.
It's pretty much the same.
Yeah.
So now I look at my company again. I hold it for like 3 years. I made a very good return. And I'm like, okay, where are we now? What do I expect for the future?
Yeah.
Because if the market is pricing it well, what I'm buying today the future free cash flow of a company from now forward. And I try to value as of today what that can be. Because I'm buying today for tomorrow. I'm not buying today for what has been.
Yeah.
Right? So if that kind of thinking, all of a sudden, it's no longer there. Those assumptions are no longer there because companies have phases, right? They grow, they reach maturity, and then they gradually go down. If you're managing to understand that, then you can start thinking, okay, can I deploy or redeploy as a capital allocator my money into other better opportunity than the one I have right now? Isn't easy because there are tons of opportunities out there. Time is what it is. So you need to know where to look. You need to know what to do. And the way I do it, I look at generally what is risk-free rate, which is called risk-free, i.e. the one that could be government bonds and this and that. I apply a little premium. I see what expected return I can have in general in that market. I look at the stock. I think now it's already overpriced or based on what you said, target price. And then I see, okay, maybe I have another opportunity.
Nothing goes up forever.
You would think.
What goes up forever?
Standard & Poor's did. The index did. Then if you zoom in, you see longer period of going down. If you zoom out, you see a constant growth. The company I told you before with a large competitive advantage is a constant growth. Some more than others, some less than others.
Let's see with the whole AI disruption if it's going to actually keep on going forever.
But I agree with you.
Fundamentally going to change, but for the average investor, like a diversification philosophy of, putting 20% in equity, 20% in bonds, 20% cash, 20% something else, real estate maybe, rather than just put all of your money in public equity.
Of course, now we were talking about public equity. I'm not telling you to do that, but the principle, regardless if you're talking about an asset class or if you're talking within the public equity asset class of different stocks, the principle is this. Why do you diversify?
To mitigate risk.
To?
Mitigate risk.
To mitigate risk. Why do you think you're mitigating risk? Because if you got, I give you the answer, because if you say, if I got all my assumption wrong here and I put all my eggs in this basket, I'm done, I'm out. And what people, by the way, never realize is that if you lose 50% of your investment, you need to make 100% just to go back to square one, which is something that a lot of people don't really realize that. But anyway, having said that, I agree with you. But in the moment in which you identify an amazing business at an amazing price, how much do you want to diversify? You still need to, but do you really want to diversify a lot?
Yes.
Right. In reality,
that's personal investment preference. I don't put all my eggs in one basket.
No, but I'm not saying 100%. But the reality is what we call concentration versus diversification.
Yeah, maybe you put 40%.
40% is a lot, exactly. So you're coming to my turf.
But you still have 60 to follow.
No. But my point is exactly this. It's I'm not talking about 1 percentage point or half or 50
instead of
basis
20,
points.
20, 20.
Correct. Exactly. So if you know what you're doing, suddenly diversification become a tool of ignorance.
The thing is, Michele, a lot of people think they know what they're doing, but they actually don't know.
But that's good for those that do. For those that do know, they should be pleased that there are people that are like that, because the market is a weighing machine. It's a transfer of money.
Now there are professionals like you that do that for a living, that manage people's money for a living.
But that's why I think that a lot of responsibility, and then here we talk about businesses, is about wealth management or financial advisory. We can discuss that. There is a moral element and there is a market element. Market doesn't do much by reallocating cash from, let's say, the smart money to the dumb money, right? Therefore, you can't avoid that, and you want that system to work that way. Because I was dumb on one day. I'm on both sides of the table because I don't know everything. I try to make the right assumption with the right price in mind, because the price is my safety net. If I'm the dumb on the side of the dumb, at least I want to pay not much, because that's my margin of safety in the price. I paid not much anyway, so I might get out of that without not losing capital, which is the rule number one, and the only rule that really matters. So by the diversification becomes a tool of ignorance if you don't really know what to do when you spread your bets out of tons of mediocre business, even if you know one of that business is a really good business. So you need to reweight your stuff, because once you see a diamond in the mud, you don't want to keep at 2% like all the other non-diamonds there. So I'm trying to obviously, I'm not saying put all your eggs there, but weighing is very, very, very important. And by the way, diversification is good up to a point, because you have two types of diversification. You have diversification across asset classes. I buy a house, I buy a stock, I buy a bond, I buy a collectible, a car or an art and stuff. And you have diversification within the same asset class. I buy an apartment, I buy a villa, or I buy this stock, I buy this stock, I buy this other stock. Right? So you have two layers of diversification.
Your portfolio diversification.
Correct. So if we stick in the column, let's call it, of the public equity stocks, you diversify by buying different stocks. And stocks are not only the same in terms of names, but also in terms of industry and sector. You can buy a technology company, or you can buy Costco that sells, or is a retailer. The dynamics of these companies are different. Therefore, you are possibly covered based on some of the dynamics that can only affect one industry rather than the other. In reality, when greed and fears hit, though, you will see how the so-called correlation out of all these different stocks is completely positive. They all go up and down. It's how much they do it. But in reality, the direction is almost the same for all of them. Almost, if not 99%. Different asset classes generally creates a portfolio that is exactly what you want, inverse correlation. If I am heavily in stocks, I want to also have an exposure in something else that goes the opposite direction if stocks goes down. Remarkably gold, or some assets that are so-called considered safety from markets, right? The more you see, though, however, in the markets now, the more you see this correlation or inverse correlation amongst assets or certain assets is this gradually disappearing. You see correlation is becoming positive across all of them with different magnitudes, but they tend to, many of them either go up or go down, except with some remarkable exceptions, of course.
This is a discussion this is
another podcast.
Exactly, another hour or two.
Correct.
Exactly.
Correct.
This has been exceptionally educational.
Oh, thank you. I hope I was clear enough.
Super clear. I mean, nobody explains it better than you.
Thank you.
Maybe if you were my professor back at uni, I would have majored in finance. But we're very happy that you decided to leave London and join us here at Multiply in Abu Dhabi.
Thank you.
And thank you for your time.
Thanks for having me.
Thank you.